You are listening to KeyStone Stock Talk Show, episode 249.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back in the saddle this week after a successful research trip to New York City. To start the show, I will hit the viewer mailbag and answer a question on Tantalus System Holdings, Inc., symbol GRID or GRID appropriately on the TSX, a provider of smart grid solutions to public power and electric cooperative utilities. The stock has more than doubled year to date, and a viewer asks if this electrification stock has wings. Aaron answers a viewer question on Perion Networks Limited, symbol PERI on the NASDAQ, a technology firm specializing in digital advertising and monetization solutions across multiple platforms, websites, search engines, and social media. The viewer is curious to hear our take on this small cap tech stock that, despite consistent growth, trades at a PE of 10, and the stock momentum has been ugly. The viewer asks Aaron, what is he missing on this company? Brett takes a look at NanoXplore, symbol GRA on the TSX, which provides standard and custom graphene-enhanced plastic and composite products to various customers in transportation, packaging, electronics, and other industrial sectors. The end market for their products are driven by the energy transition, so EVs and renewables. While revenue has been increasing, the company is not yet profitable, and its shares are down 21% over the past year. Is it an opportunity? Brett will let you know. Finally, Brennan answers a question on Major Drilling Group International, symbol MDI and the TSX. It provides contract drilling services for mineral and mining exploration companies with a fleet of over 600 drills operating in over 20 countries. Despite gold trading at record highs, Major Drilling stock is flat to slightly down over the past year. The viewer asks if this company is a good way to play the uptick in gold. All right, let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing? How's everyone?
Doing well.
Doing good.
Good.
Yep.
Excellent.
Well, do you have any exciting news this week?
I had an interesting trip to New York. Once I was there and I was there with a family for a couple days ahead of time. We were going to be there for 5-6 days. We ended up there for just 3 days, thanks to Air Canada. I was scheduled to leave on a flight on Wednesday at 8:20 in the morning. The flight was delayed. We left okay, but we got to around, New York, and we started circling. My daughter actually looked at that little screen that you have on the plane on the back of the seat. And she said, "Dad, the plane's circling." I'm like, I doubt it, but I looked and the plane was circling, and it went from about 20 minutes away to an hour and 45. So at that point, we knew something was wrong. There was windstorms in New York. We ended up landing in Montreal. And of course, in Montreal in April, which seems like, it should happen, there was a snowstorm. And we were sitting on the tarmac for about 4 hours from 6 till 10:30 at night. Several delays, and we ended up disembarking, getting off the plane, and we ended up in a hotel in Montreal that night. Difficult to find, but we got there in a snowstorm, and our flights were rebooked for the next day at noon. Well, we got there, and we thought we'd be taking off at noon, and there was a 2-hour delay, and then the crew timed out, so they had to find a new crew, a 2-hour delay. We got on the plane, so we boarded the plane, and we were on there at about 4:30. I think 4:30 we got on the plane. They hadn't checked the plane. It had been sitting there at the gate overnight. It was the same plane we were on the other night. So initially there was a issue with snow in the engines. It was only 1 degree, so I'm not sure. There's planes flying out all around us. We're sitting in this plane. They bring over some heaters. Then they find it to heat the engines. Then they find a mechanical issue. Then they find a software issue. And we're sitting there for another 4 hours. I think we finally got out of there at 9:30 when they called it on the plane. We did have some water and a bag of pretzels, which was nice. And with an 8-year-old, that's always great. So we end up in a hotel again in Montreal. Come in. I'm making a very long story. Trust me, short here. Come in at 9 a.m. the next morning for a flight out, 2-hour delay at that point for I don't know what. We get on the plane, sitting there for an hour. Then we get news there was an earthquake in New York. So as we're taxiing out, and they have to spend another 3 hours, we're 3 hours in the plane again, waiting for them to check the airports. And we finally got to New York in our hotel around 6 o'clock on Friday. Started at 8 a.m. Wednesday morning in Vancouver, ended in New Jersey, I think, at about 6 o'clock on Friday. Not a good travel experience. And Air Canada did, though, after all that, offer us 25% off the next flight we book with them, which I thought was incredible. So, which now, I said,
when to them was delayed a couple of hours in Calgary when we're coming back from the Roth conference.
Yeah, Brennan was, right?
Brennan was quite upset.
It's still hideous. He had to spend the night there, but
but it's not like it was just a one-off event. It's been literally like the last 5 times I've flown, there's been some kind of delay or whatever. But
almost exactly what I went through.
Yeah, almost exactly.
I'm kidding. No, I just had to share that because it was, it was really fun going through that. It was great. But when I got to the conference finally, and we tried to jam in before the conference, we jammed in all the tourist stuff in New York in about 75 minutes. And then I went over to the conference and, some good companies there, good interviews, interviewed some companies that are in coverage. 3 of them right now got some updates, which is great. 2 new companies, which were quite interesting that we we're doing some more due diligence on right now and may have some recommendations for clients over the next month. So we're looking at those companies closely. So it was good to be at the event, good to sit down. They had they do some good hospitality at that event as well. So it was good. It's good. And now we're going to look at the poll, I believe, from last week. Is this correct? Or does anybody want to talk about anything else? Anybody got some horrible stories?
Brennan and I passed the level 3 CFA exam.
Yes.
So
congrats.
Thank you, gentlemen. Thank you.
Yep. Level
congratulations.
3.
So we haven't actually earned the charter yet. I still need to, submit and get my references, and hopefully Aaron gives me a good reference. And
probably not.
We'll see if I ask Ryan.
I think we all know the answer to that.
Being gonna ask me, yeah.
Yeah, but we'll see. We'll see. That's still debatable. But yeah,
I'll just say he's a bit shifty. We'll say, is that okay to put in there?
Yeah, you could say that.
The word shifty in there would be good.
So most people probably don't recognize the accomplishment of passing the level 3, but it's
3 years.
Chartered financial analyst designation or charter is pretty big deal in the investment industry, and it's quite the gauntlet to get through those 3 levels of exams. So
again, a round of applause. This is a round of applause.
How many hours of studying would you say per level?
Well, I'd say easily 300, but Brett was able to pass all levels on his first attempt, which only 6%
which you were too.
Candidates. No, I didn't do that.
We don't have to tell anybody anything.
But we're
not obligated.
Over all of the levels for me, I would say I probably studied 1,500 hours in total. And I mean, for me, it was an absolute headache because I was trying to write the level 2 in the midst of COVID, and all this new material was coming at me. They delayed the exam by 3 months. I started studying again. I don't know. It ended up being like a year and a half of basically studying and not getting to write the exam. So, it was just...
For the average viewer, what would be really instructive is if we showed a picture of your room. That would be very instructive. If we did
I can do that.
With all
your... Yeah, you can put
That's
it up.
only with your permission, though. But Brennan
permission.
has literally notes everywhere. It's amazing.
You have my
I would advise you.
That's
Look away.
You can put it up. I am proud of it. It's a lot of work, but anyways.
Well,
Yeah,
good.
no, it's amazing.
Congratulations, guys.
Well done. All right. Now
Hopefully
that we've got that out of the way,
enough to
let's get to the
sponsor
poll.
Yeah. So we. So this was actually a repeat of a previous poll. Do you have any investments directly or indirectly in Bitcoin and cryptocurrencies? This time it was yes at 27% and no at 73%. And previously, about a year ago, it was 20% yes. So there's been a slight uptick over the past year for our viewers, which I'm not exactly surprised by, given the US ETFs. Now we actually did a report on that, a special report. If you just sign up to our website, I think you'll get that.
And any client is getting that. Yeah. So Brett did a full review of, you talked about cryptocurrencies, you talked about Bitcoin, Ethereum, and then just the ETFs that are based off of them.
Mm-hmm. Exactly. There's a bit of difference between the US and Canada as far as how it is to invest. So look at that report if you're interested in it and you are a client at this time. But I don't know if you guys have any comments.
I just know some of my friends have been buying more recently. I mean, I don't know if
the time to get out is now.
We did a section as well.
Which of your friends?
In the DIY events we just ended last week, we also did a section on Bitcoin and Bitcoin investing, and then as well took some information out of that report. So,
and we're partial to cash flow producing investments, so and we'll give our take on it. We gave it in our seminars. You can still access those seminars. Brett might put this out in the podcast, but there's the on-demand version right now. If you didn't see our first webinars, our spring webinars, we don't have any until the fall. So if you want to get a hold of those, I think there's 7 recommendations in there, companies that we've done a ton of research on. If you want to get a hold of that webinar, you can go to our website, www.keystocks.com. Click on mine, Aaron's faces, punch them if you will, if you need to. And then you'll get access to that. You can purchase a ticket and get it on demand in your account. All right. We are we going to kick into the show? Because we got 3 or 4 companies to go through today. So we probably want to move fast. I'm going to start by looking at Tantalus Systems Holding Inc., symbol GRID or GRID on the TSX. The stock trades around $1.86. $83 million market cap, doesn't pay a dividend, but they're in a growth phase. What does Tantalus do? They're a provider of smart grid solutions to public power and electrical cooperative utilities. The company's hardware, devices, software, applications, and related services are designed to automate, monitor, and control power flow, consumption, and quality to improve grid reliability. Now, this first slide here should show you the last 7 years of business in terms of revenues and operating income. There's been moderate consolidated revenue growth, but nothing spectacular. And operating income has primarily been negative. Let's look at the share count over the same time horizon. There's a significant increase. It's slowed down of late, but over time, there's been a significant increase. The company, again, like I said, is in a growth phase. When you don't make any money, though, you have to fund operations either via debt or issuing shares, and the company has done both. So let's look at the recent Q4 and 2023 annual highlights. Tantalus generated its highest annual revenue in its history, $42 million US. That's about 56.8 million Canadian, 6% increase over the previous year. Revenue contributions from the utility software, applications and services segment in 2023 hit 35% of the company's total revenue. That's the highest percentage contribution in the company's history. Its annual recurring revenue, or ARR, was a record up to approximately 11.5 million US, 15.2 Canadian. That's 17% growth year over year. Recurring revenue recognized in Q4 represented approximately 24% of total revenue generated. Adjusted EBITDA was positive at about 0.35 million, about $500,000 Canadian. The Q4 that was positive in Q4 compared to adjusted EBITDA of 0.1 million, approximately 0.1 Canadian for the prior year. Adjusted EBITDA for the year was approaching kind of neutrality, about 26,040 Canadian, 26,000 US. That was a loss compared to a loss of 2.4 million, or a loss of 3.1 million Canadian in the prior year. The EBITDA, we would note, includes approximately $5 million US of further investment in its TrueSense Gateway, the product offering that is really the future of this business, and that was made throughout the year. Pull that out, and the company is saying it would be significantly more adjusted EBITDA positive. Now, let's look at valuations here. This is the balance sheet we're going to look at first. The positives here: cash is 5.2 million, debt is 11.4, and lease obligations of 3 million. So the company is in a net debt position. We can look at the valuations. That's a summary there of that. The valuations here, they're high right now on a trailing basis, 65 times EV to adjusted EBITDA. Forward looking, this is based on not our estimate, but one report that is out on this company, is about 23 times PE. Well, there's no PE trailing as the company is not profitable. Going forward, the company is expected to do about $0.01 next year. So 180 times next year's earnings. Our conclusion here, simple. The positives for this business: Tantalus provides leading grid modernization technology that allows utilities to collect, manage, and analyze data. The company's platform directly supports decarbonization and the electrification of everything. It's gaining traction with a strong value proposition to regional co-op utilities, municipalities, and some investor-owned utilities. Now, the TrueSense Gateway is the future of Grid's product offering and provides the utilities next generational advanced metered infrastructure capabilities, improved power quality analytics, and most interesting, behind the meter access, among other features that it provides. Initial feedback has been from the early adopters. Its early clients has been very positive and confirms the product is addressing needs that are out there of decarbonization, like we said, electrification, and aging infrastructure. We like the business. This is our take finally here. The potential of the business we like, but the annual recurring revenue is still just 15.4 million Canadian, and Tantalus remains cash flow negative over the past year. Our minimum criteria for investment is positive cash flow, and Tantalus has yet to achieve this. We continue to monitor the business, but found more profitable ways to invest in electrification and aging infrastructure through names like Hammond Power over the past 5+ years. All right, that's going to finish my answer on Tantalus today.
Great. Fluctuative revenue, no profitability, high valuation, EBITDA, all the attributes that you love.
Yeah, I mean, and it looks to be in a segment that has long-term potential, and there is growth in that recurring revenue base. But the recurring and the software base is still a smaller part of this business. I think the company has kind of caught fire at the start of this year, and while there is good potential, and it doesn't trade at a massive multiple to its sales, it's we need profitability, and we're not going to. Even if we like a business, like the industry they're in, see great potential in it, if a company is not profitable, we are not going to invest in it. That is one of our minimum criteria. And it serves us well because we're also looking not to lose money for clients. And a company that's proven they can make money is in a better position to make you money as a shareholder. I mean, in this case, they have to be significantly more profitable, even going forward, based on the estimates for us because the estimates going forward, which do look quite rosy, would leave it still trading at high valuations.
Yeah,
all right.
I mean, like the stock has, like you said, had a good run this year, but looking at generally the overall market, companies that are issuing shares, have debt on the balance sheet, and aren't profitable right now. Well, the market's just not been giving these kind of companies love. And
we're going to sit down with management team in about 2 weeks because, again, we like the story. They're at a conference we're at. We're going to sit there and gain further insights into the business, where they're going to go going forward. We've talked to them in the past as well. Often we'll monitor a company 4 to 5 years, especially in these stages, before they become a recommendation. And most of them don't become recommendations because they don't meet our criteria and end up trading at reasonable valuations at the same time. So if that happens, maybe Tantalus makes us into our coverage. But at this point, we're continuing to monitor them. And when I say monitor them, we really are. We're going to sit down with management in a couple of weeks and interview the team. All right. Great. We're going to move on. Aaron, you're going to look at Perion.
Perion, yes, Perion Network.
And this question actually came from a viewer who actually was mugged by KeyStone. They won a mug. So that's been sent off. Hopefully the viewer has it. And if you want to get mugged, Aaron, you've got a mug there, don't you? Can you show that to everybody?
Yes, I can.
Nice.
Can you see that?
If you want to get mugged, have a great question or two, and we'll draw you every month, and we'll draw a winner soon this month. So keep those questions coming into our Your Stock Car Takes, and we'll send you out a mug if you're selected this month.
All right, let's take a look at Perion. Question was, curious to hear your take on the small cap tech stock. Despite consistent growth, it trades at a PE of 10 and momentum is ugly. What am I missing with this one? Thanks. This is from Noel via email. So Perion Network Limited trades under the symbol PERI on the NASDAQ, trading at about $12 per share, $600 million market cap, and 50 million shares outstanding. Perion's a technology company, essentially an ad tech company. They specialize in digital advertising and monetization solutions across multiple platforms like websites, search engines, and social media. What they do is they leverage advanced data analytics for audience targeting. So if you look at the company's share price performance over the past 5 years, fairly volatile the whole way along, but doing fairly well up until around May of 2023. Since then, we've seen a significant drop. And the viewer's question was right on point when with respect to the momentum, which is quite ugly. So the share price a year ago was up over $40 and trading today at about $12. Just recently, over the past couple of weeks, big drop in the share price, losing about half of its value. So what's going on here with Perion? Now, if we look at the company's historic financial performance, for example, revenue, we see good, strong revenues, consistent growth in revenues over the past 6 years. Same can be said for normalized EPS, particularly over the past 3 years, very strong earnings growth, but consistent profitability. So this begs the question, why is the share price not reflecting this growth? Again, we can look at the balance sheet, the financial health. Huge net cash balance on this company. So the cash and equivalents, 472 million, debt of 7.6 million. So that's about 465 million in net cash, or $9.50 per share in net cash. Most of the company's value is actually just in the cash balance, trading again at about $12. So, and it's a profitable company. So one would expect that it wouldn't be trading at, what is it now? Actually about 5 times earnings on a trailing price to earnings multiple, or, roughly around 1.5 times earnings on a cash out basis, enterprise value to trailing earnings. So what is the issue? Well, there's a few things happening with the company right now. One was a substantial reduction in the company's 2024 guidance and expected financial performance. So they put out 2024 guidance just a couple of months ago with the 2023 annual results. And they were expecting to see decent growth, revenue in the range of 860 to 880, up from 743. Some growth in adjusted EBITDA as well, at about 180 million compared to 169 in the previous year. But only a few months later, they've had to make a substantial adjustment to that EBITDA. So they're now expecting to see revenue of only about 600 million, which would be a 19% decline, and a huge decline in adjusted EBITDA, 53% decline compared to the previous year, down to about $80 million. So this is a major issue for the company in terms of not just whether or not profitability is going to be sustained, but also investor confidence as well. There's a few other things that I think are dragging on the valuation. One is they're actually a foreign issuer. They're based in Israel. So that in and of itself is going to result in a discount. we've seen this before where there's quite a few Israeli-based companies that have a good, strong track record of growth, profitability, but they can never quite get that discount. Foreign issuers do have different guidelines in terms of disclosure. They actually don't release a 10Q or 10K report like a domestic US company would. They release what's called a 20F. So less disclosure guidelines. Now, a lot of these foreign issuers do disclose above the minimum that is required, but still, it doesn't fit nicely in the basket of a U.S. stock. So a lot of people, a lot of investors are a little averse. Probably a lot of funds are restricted from owning them. So there's certainly a discount there, and as well Israel, with all of the fighting that's going on there right now, that's another source of uncertainty. Beyond that, there's high dependence on Microsoft. Microsoft is the company's biggest customer, 34% of revenue last year. Now, 34%, that's pretty significant customer concentration. I've seen a lot worse, but one of the things that is been attributed to the adjustment to Perion's guidance for 2024 were some changes that Microsoft made to its Bing system. So certainly there's a lot of dependency there. Another thing that's not listed here as well is that many ad tech stocks overall in the small and mid cap space have not been performing well. Ad tech as an industry is expected to experience strong growth, but a lot of these companies are competing with names like Google or Meta, which are acquiring market share. So there's at least an investor perception there that this market share is being acquired at the expense of some of the smaller companies. Now, that may not be the case. Small to mid tech, ad tech companies really vary in terms of their scope. A lot of them don't compete directly with the big companies, but that is certainly an investor concern. So another thing that we want to know is what is the company going to do with its net cash? And there's a substantial net cash balance there. And we would expect the company to be aggressively buying back shares with that money, given where the share price is. I mean, one would think, why would you purchase another business when your company is trading at such a low valuation? So we have looked at what the company's plans are based on the conference call. They're saying that they're going to focus on continue to invest in technology. They're going to consider additional mergers and acquisitions this year. In their conference call, they mentioned that buybacks and dividends were not ruled out. They've recently announced a $50 million buyback. But the primary focus, they say, is on creating long-term value by growing as fast as possible and providing value for shareholders through market leadership, as opposed to through buyback. So I can understand the strategy because a buyback, although it is increasing the existing shareholders' ownership in the business, doesn't necessarily improve the operations of the business. And they already have a fairly tight capital structure, but they also need to show that they're going to be able to do something with this net cash. If they're not going to be able to invest aggressively in technology, something that's going to produce tangible benefits over, say, the next 12 to 18 months, then many will wonder what the net cash is doing there, just sitting and not really doing much for investors. So we love companies with net cash, but it's not helping investors if it's just sitting in a bank account. This is something that people need to be aware of. So just in terms of our take on Perion, well, they are the biggest asset right now that I see with them is that they're sitting on a colossal amount of net cash. Now, if we look at valuation, they're trading at a very attractive valuation, a stupidly attractive valuation relative to the trailing earnings. However, with the big decline, big reduction in guidance so far for this year, if we're looking forward, we can't rely on that valuation. So we don't really know for sure what the earnings are going to be in 2024. I'm guessing that a lot of those earnings are actually going to come from interest from their cash balance. Now, it's not a bad thing to bring in the cash flow, but you want to see that the operations, the continuing operations, are profitable and generating growth, because Perion is not a bank. So sitting there and making interest income off of their cash balance is not what investors are looking for. So this substantial reduction in guidance for 2024 is a concern. It does draw into question whether or not they're going to sustain profitability from continuing operations. but it also makes us question what's going on with the business in terms of, does management really have any idea what to expect in 2024? If you're reducing your guidance by a moderate amount, that's understandable. But if you're dropping your revenue guidance by 19%, you're dropping your adjusted EBITDA guidance by over 50%. That is really an indication that there are uncertainties that not even management is able to get their head around right now. So how are investors supposed to? Our take right now is to be cautious. Yes, if you look at this from a net cash, from a fundamentals basis, there are a lot of great arguments to say this company is extremely cheap, but we wouldn't necessarily rush into any positions. We think it's still high risk. Although the net cash is attractive, they need to find a plan and actually execute on a plan to deploy it. So for now, we just continue to monitor the company. And we have actually spoken with management in the past. Last year at the Roth conference, we had an in-person meeting. We may reach out to them again, but we would also like to see how things trend over the next couple of quarters, because that share price graph looks really ugly right now.
Yeah, and I mean, it looks like, and that essentially the reason they had the decline, obviously, it was attributed to changes in advertising pricing and mechanisms implemented by Microsoft Bing and its search distribution marketplace. So, if just a change by Microsoft, and they say the relationship's still good, but if it just a change can amount to that much of a decrease in profitability, decrease in revenues, how much control does this company have over its business, really? Clearly, not a ton of control in terms of its relationship with Microsoft at that point, because one change by Microsoft impacted them significantly. So,
yeah, I mean, the dependency is obviously a major risk, and you don't know what Microsoft is going to do in terms of changing their system. So maybe this is just the beginning of it.
And when you talk about customer concentration risk, this is kind of a case in point where, this is their major customer, and that change that they had no control over and likely didn't see coming affects the business massively right away, from point one. So that's the risk when you have an existing customer that is that large part of your business. Okay. Well, any other comments on Perion? Or are we moving forward?
I think we can move forward.
All right. Well, Brett's got the floor, and you're going to talk about, who are you talking about today? You let us know.
NanoXplore today.
NanoXplore. GRA, right?
Yeah, GRA, you got it this time. So NanoXplore, symbol GRA on the TSX, provides standard and custom graphene enhanced plastic and composite products to various customers in transportation, packaging, electronics, and other industrial sectors. The company has 11 production facilities across the US and Canada, as well as one in Switzerland. The end market for these products are driven by the energy transition. So your EVs, your renewable sources, that's where they are targeting. The stock is down 21.6% over the past year to $239 a share, and that ends up with a market cap of 410 million Canadian. So looking at the last quarter, fiscal Q2 2024, which is December 31st, 2023, so they're shifted up 2 quarters. Revenue is down 8% to 29.1 million. The company does attribute this to a 6-week strike at one of the major OEM customers. The company believes that sales would have been higher than the previous year without the strike. The estimate for this variance is about $3 million. So the estimated revenue, if you remove their estimate of the strike impact, would have been $32.1 million, or about 1% growth year over year for revenue. Gross margins did improve to 19.4% from 17.8%, or up to $6 million from $5.9 million in the prior year. So that's gross profit at the $6 million. Despite the lower sales, which is good to see, as that reflects operational efficiency and maybe some economic scales of economics if they were to have higher sales, of course. So that is something you always want to look when these manufacturing companies over time is their margin improving for the gross profits, their operating margins. You want to watch that figure, because you'll see sometimes these companies, they just chase revenues. They're not they're actually decreasing margins to chase those revenues as they're being rewarded off of revenue initially. That cannot be done in the long term because you'll eventually need to be rewarded off of earnings, not just revenue. However, the company has increased its operating loss to a loss of $2.6 million from a loss of $1.7 million. R&D, SG&A, and depreciation all ticked up across the board. So that can be actually diseconomies of scale if you saw that completely just tick up over time and the sales are not outpacing it. So that's something you really want to watch. This was a bit of a weird quarter with that strike. So that's something you do want to track is SG&A, is R&D, and depreciation all ticking up at a higher rate than their actual gross profit over time. And that at least happened during this quarter. The company does guide for revenue of $130 million for the year, an uptick for the second half of the year due to the expansion of existing programs, adding another $30 million. And that would put likely still a loss, as they had a loss of $2.4 million, effectively no change for this last quarter. So just annualizing that, you're looking at really just $10 million, loss of $10 million or so. So then if you're adding another $30 million revenue onto their gross profit, even at that point, they're probably still not going to be profitable by the end of the year. But the company does have a net cash position, including their leases, of $5 million. However, this will shift significantly into debt, as the company will be taking on significant debt to execute its 5-year plan, which is expected to cost between $140 and $150 million. And that was actually reduced from previous estimates of about $170 million. So that's good to see a budget actually being reduced for a change. You don't see that common in either companies or governments. The company will have government support, but the exact details have not been announced at this time. So that will be something you want to watch out for, is how much is the government ponying up? How much are they going to actually have to raise? And what are the actual terms of their credit facility? And how long is the debt actually going to be on their books? So the 5-year plan is targeting to expand capacity significantly from 4,000 tons per annum to 16,000 in 2026, then to 20,000 in 2027 of combined graphene and battery materials capacity. The bulk of the capex is expected to begin to come online in 2026, which is for graphene and battery materials, which is expected to add about $140 million in revenue. The Lightwick composite factory or facility is expected to add an additional $80 million, which is expected to begin in 2025. Additionally, the company may see additional growth from its NanoXplore segment, which is graphene enhanced lithium ion batteries. Whether that adds additionally on, they haven't said the exact numbers. I think it's a bit up in there, because that is really the issue with these technology-driven companies. They need to figure out the uptake, see how that figures into the financials, and go from there. So it's still probably a couple years out before they're going to have figures themselves. The company has had dilution over the past few years, but nothing unsustainable, which you do sometimes see in these emerging technology manufacturing companies at times. The substantial increase, which was in 2021, was related to acquisitions. So overall, the share structure really isn't a concern at this time. You're not seeing that hockey stick of share count increase, which is the opposite of what you want. The hockey stick, you want that in price, not the share count. So, but however, the company is still expensive, as the company does not have really any profit or even consistent positive adjusted EBITDA. They've had a couple quarters here, then they'll have a loss, and it's really trailing. It's near zero, which it just has a massive meaningless ratio at that point. But for price to sales, it's roughly at 3.2 times the forward sales, so their fiscal 2024 sales, which for a manufacturer is quite expensive even when you are profitable. Yes, the growth is expected to uptake in the second half, and they are going to see quite a bit in the 5-year plan. But they've also seen really no real growth organically over the past year. Even if you discount the strike, 1% is really meaningless when it comes down to it, when you are having such a high multiple. And if you're looking forward off the 5-year plan, it comes to a ballpark figure of 39% compound annual growth of revenue from the expected 2024 rate to 2027 and that would be putting them at about $350 million at the end of 2027. But that doesn't include any other additional organic growth, just those 2 additional facilities coming online. So whether or not they have additional or they even have contraction for whatever reason, that isn't included in that growth rate. As well, you don't know how much of that is going to actually trickle down to the bottom line, whether that's going to be want to turn 20% gross margin, or is it going to be 40, or is it going to be 5? You need to see that play out a bit more. So concluding, the company is speculative at this time. The growth has been lackluster over the past year, but the expected uptick is positive, as well as they have improved gross margins, which is good to see, but the growth is low given the current valuation, at least for their historic last year. But the real growth is expected to come with their 5-year plan, those 2 new facilities, and it is actually quite good growth looking forward, assuming they are able to hit those targets. But that is only for revenue for the company, and it needs to be successful. And by converting their revenue to the bottom line, they need to hit that cash flow as well, especially given that they are taking on debt to complete this plan. So they are taking on that 140 to 150 million in debt. In what form is up in the air right now. It is going to be in some sort of credit facility, but the exact rate hasn't been announced. But their current debt is upwards. It's between 6 and 9% for their actual normal standard financial debt. So you're probably looking at somewhere in that range. So 7.5% or so, that's already a hurdle they need to pass to actually have any accretion on their bottom line. And that is always the worry when you are starting to take on debt. As well, of course, they are an emerging technology, so they have risk of competition, customer uptake. Are customers actually going to be able to buy up all the demand from the new facility? Because it's no use when the new facilities are at 10, 20% utilization. You have a whole big empty facility, and you have to pay the overhead cost for that, but you're not getting enough sales. So you have to worry about that customer uptake. As well, you have general end industry slowdown. So notably the EV today, the Tesla announced 14,000 employees being laid off. So is that a sign that the EV industry is slowing? That's really the question at this time. But that is obviously a risk for NanoXplore if the EV industry does explore. It's not their only industry by any means. They do have other industries, stuff like power tools, even use that can potentially use the graphene batteries, and other industries amongst that, solar cells as well. It can be another one. But so it isn't dependent on the electric vehicle industry, but a slowdown would hurt them, is my point. So for now, I wouldn't really enter. I would wait to see how their 5-year plan really hits the financials, how those plants come online. Are they going to be accretive? And are they going to be able to overcome that expected debt load, and as well as customer uptake and sales and so on, and economies of scale? So for now, I really watch that. It's not a complete write-off in this case, like you do see. It's not the buzzword graphene or graphite companies, these which you see sometimes, which we've looked at a couple of those before, I think, on the podcast. So it's not one of those. It's one of these ones, though, which they do have potential, but you want to wait another couple of years to see how it pans out a bit more.
Yeah, and I would say at least this company does have sales, does have revenue. There is growth. There's a path of growth ahead. Mm-hmm. Our minimum criteria is profitability, cash flow. It's not there right now. And with this company, I would say your bet is on graphene prices long term, and if this company can be profitable, and your bet on whether or not the demand, you've seen this demand scale that says every year the demand for graphene is going to increase. Is it going to increase at that rate? And then are there going to be other suppliers that come in? And what is the supply demand situation going to be? And thus the price of graphene. So all of those things, which makes, the business difficult to analyze, to be honest. And it's not that you can't analyze it, but you are forecasting greatly on this business when you're forecasting earnings going forward.
Mm-hmm. Yeah, they're right near that zero profitability right now, which is why they might have a ratio quarter to quarter for some of them, but they'll be meaningless numbers. Just for anyone's wondering why I didn't put those out there.
Excellent. All right. Well, Brennan, you want to talk about major drilling, shifting gears from graphene to gold, from G to G. Yes, we go to Brennan.
Gold and copper, primarily.
The new CFA.
No.
Almost.
Yeah. No, almost though. So yes, your stock our take came in from Michael, who's a client actually, and he says would like your opinion on major drilling. Seems to have good numbers as far as I can tell, but seems range bound. And he also said that he loves our podcast. So thank you, Michael. So Major Drilling Group International, MDI, on the TSX, currently trading at a price of about $9.51, market cap of about $757 million. And the company provides contract drilling services for mining and mineral exploration companies with a fleet of over 600 drills operating in over 20 countries. So I did provide up on the screen here the customer and commodity pie graphs shown on the screen, which are from the company's March 2024 investor presentation. And it shows about 80% of drilling revenue comes from seniors and intermediate companies, and 62% of drilling revenue is split evenly between gold and copper. So, as Michael mentioned, the stock has been essentially kind of range bound between the $7 to $11 range. So let's just kind of dig into what is keeping the stock range bound. So, of course, first looking at the last quarter, looking at the financials here, it was for Q3 of 2024, which is seasonally the company's weakest quarter. Revenue was down 11% to 132 million year over year. And this was primarily due to U.S. drilling operations decreasing by about 22% due to a seasonal shutdown of certain drill programs earlier than in the previous year, due to budgets being spent quicker as a result of inflationary pressures and a lack of junior and intermediate financing, which has driven a more competitive pricing environment. For South and Central America, revenue increased about 4.6%, with growth in the region supported by busy markets in Chile and Brazil. But this was slightly offset by slowdowns in Argentina due to the elections, and Australasian and African revenue decreased by about 1.3%. Gross profit was also down about 29% to 18.9 million. EBITDA, again, down 44% to 11.4 million, and net loss was a loss of 2.3 million or 3 cents per share, compared to a gain of 6.3 million or 8 cents per share in Q3 of 2023. And one of the primary reasons for the loss was due to a foreign exchange or FX loss of 2.3 million due to the Argentina peso depreciating, again, due to economic reforms implemented by the new Argentinian government. And looking at the balance sheet, it remains quite healthy. Net cash position of 96.4 million, which equates to about $1.18 per share. And the valuations for the price to adjusted EPS figure, I did remove that negative FX of 2.3 million in Q3. So if we're looking here, it actually is about 11.9 times earnings. And it has an EV to EBITDA of 5 times and a price to cash flow multiple of 7.3. So the shares outstanding have stayed quite stable over time, which obviously is positive to see, as management is not diluting shareholders. And in the recent press release in relation to the company's strong balance sheet, management noted that they continue to invest in the rig fleet, with capex of about 21.4 million during Q3 of 2024, which included 6 new drills, while disposing of 3 older, less efficient drills, bringing the total fleet count to 605. As well, the business spent about 2.7 million in the quarter acquiring and canceling just over 300,000 shares at a weighted average price of $8.45 per share. And they were questioned on the conference call whether management would increase the activity of the NCIB or buying back shares, given the strong cash balance on the balance sheet. But management did note that growth remains the primary focus, given the strong demand in terms of copper and gold activity, given strong commodity prices. So to conclude here, growth in 2021 and 2022 was significant given easy access to funding, but slowdown in financing is affecting these regions, primarily North America, and especially juniors and intermediates, with all current growth, according to management, coming from senior companies. Strong commodity prices for gold and copper do bode well for seniors to continue to drill. Fundamentally, the business is strong. It remains profitable despite some headwinds to growth. It has a strong balance sheet. They've been buying back shares. They continue to invest in the rig fleet. They have reasonable valuations, I would say. But the big question is, why is it stuck in the range? And I think that generally it has to do with just the moderation of growth from the strong levels which we saw over 2020 to 2022, when access to funding was very, very easy. So essentially, we saw the stock run up to its current range after experiencing that growth, but has struggled to move higher given some of these headwinds in funding, which are leading to a bit of a slowdown. Overall, though, I think that Major Drilling is a decent company. The balance sheet is robust. And for anyone, who thinks the business will benefit from increased copper and gold prices, and hence, drilling activity in the space, I think that it could be an option. But as clients know, we do have a different driller under coverage, which also possesses attractive fundamentals. And that is my piece on Major.
Okay, thank you for that. I think you might be muted, Aaron.
Yeah, I'm off now. Yeah, it's an interesting way to play the mining space. I mean, as you
Picks
said,
and
Brian,
shovels.
the fundamentals
Mhm.
are actually quite strong.
Yeah.
There'll be some volatility there. Although, I mean, one thing I do note is that the company does seem to have spent most of the last 10 years not generating a profit. Although profitability has been fairly strong over the last 5 or so. So
yeah, and it's definitely something that we're hearing. Just funding has really, like, even despite the strong gold price, for these junior exploration companies and stuff. Like, again, they're beholden to the capital markets.
Yeah, it's an interesting time because typically when you see gold move higher, funding it loosens up. It's easier for junior mining companies. I don't think there's been a time in the past. Well, gold is at record prices now. It does typically take 6 to 12 months to filter down, and gold has really gone on a run over the past 3 to 6 months. So potentially you start to see some loosening up in some of those junior companies raising more capital. But the junior companies have a terrible track record of creating value over the long term. So perhaps investors, it hasn't been long enough since they lost, and their memories are still in place that they haven't done well in this sector. There's advisors out there like
juniors don't
ourselves
actually have any gold is the key thing, right? Like they maybe have some gold buried deep in the ground in their property that possibly could in 10 years.
I mean, most of them, in any gold environment, most 99% of them I wouldn't touch with a 10-foot pole. So in any gold environment, I'm saying that. But there are some gold companies that should likely could have a higher price right now. I mean, and typically in a higher gold environment. But again, even gold producers, Aaron did a segment on this on our past couple webinars about how well even some of the best gold producers have performed over a 10, 20-year period, and in comparison to some other sectors. And it isn't pretty. So,
no, they don't. They're not good proxies to the price of gold, unfortunately. And if you look at, like, say, gold mining stocks over the last 15 years, on average, they've lost money. And I don't mean on an inflation adjusted basis. I mean on a nominal basis. So you add inflation to that, and they've lost even more. Now, whereas the gold price has obviously it's come up a fair bit since then. So it's not historically being the best way to get access to gold.
Yeah,
and
or go on, Ryan.
As our clients know too, we've we've had a better, less risky way of playing gold over the last 3 to 5 years. And over the last even just year, that company is up 65%, pays a great dividend. And, it's where the gold sector has not done well, despite the price of gold. But this company is doing well because of their exposure, but also because they just make money consistently for 13 consecutive years.
Mm-hmm.
It's strange how that makes a difference over the long term. And it does. And we're seeing that. And so anyway, then our clients have been invested in that for 5 years, and it continues to do well. It's not the least risky company out there, but as part of your 15 to 25 stock portfolio that we hammer home every week on this show to our clients annually, the company makes sense. And you see the outperformance relative to the gold sector and even the price of gold, which has done quite well over the long term. So that's why we're invested in that type of cash flow positive business.
Yeah, like I know we've used Barrick as like an example before, just looking at the price of gold compared to Barrick. And I mean, in 1995, a year after I was born, it was trading at around $31. Well, today Barrick's trading at about $24, and realistically, it hasn't been on a steady climb over all the decades there.
Yeah.
Anyways.
No, it's a good point. All right. Well, I think that will close out our show for this week. And again, as I always wish you, keep your questions coming in to our Your Stock, Our Take segments. We'll answer those. We're going to be giving away a mug short term here, maybe next show. So get those in, and we'll give one away over the next couple of shows. As always, also, if you're watching this right now on YouTube, smash the subscribe button. If you're listening to it on iTunes, rate and review us. Like I say, always positive reviews. Again, thank you for listening, and I wish you profitable investing.
Thank you.
Thanks, everyone.
Thank you.